Hello and welcome to part 2 of the finals review for the sample questions. So as we know, basically when a company takes on more debt, it increases the risk. So the lower the debt ratio, the lower the interest rate the bank would charge the firm, but greater the debt, so the greater the risk. So this is what Hamda equation basically tries to figure out what the levered beta is. So here you have a Brandy Corporation with an unlevered beta of 1.2. That means without any debt, that's its risk, the beta. The firm currently has no debt, but it wants to take 40% debt and 60% equity. It has a corporate tax rate of 40%. So you need to, based on the Hamda equation, you want to calculate the levered beta. So the formula for the levered beta, beta for levered equals the unlevered beta brackets times 1 plus 1 minus the tax rate times the debt to the equity ratio. So we know the unlevered beta is given as 1.2 brackets 1 plus 1 minus 40% is your tax rate right here. So times 40% debt over 60% equity, or 2/3. So 0.6 times 0.666, 1 plus that equals 1.4 times 1.2 equals 1.68. That is how you would calculate the levered beta. Okay, so remember that the lower the debt ratio, the lower the interest rate the bank would charge, and greater the risk, greater the beta, the levered beta is going to be higher, okay, if the more debt the company takes on. Let's do the next problem. So in this problem, they want to figure out, based on the residual dividend policy, what will be the dividend payout ratio. So Aldo has a budget, capital budget of 2 million, wants to maintain 70% debt, 30% equity, and it forecasts the income to be $700,000. So let's put a 70% debt, 30% equity, 2 million is the capital budget, 700,000 is the net income. So we know dividends based on the residual policy, it's net income minus your target equity ratio times your target capital budget. So we knew our net income is 700,000 minus our target equity ratio is 30% times the capital budget of 2 million. 3 times 2 is 600,000. So 700 minus the 600,000 equals 100,000 left over for dividends. So they are asking one more step you have to calculate. What did we pay out of our net income? Basically 100,000 divided by the 700,000, or what percentage of our net income did we pay out as dividends, which is 14.3 or 0.143%. Okay, so two-step calculation. Next one is the U.S. Treasury offers to sell you a bond for $513. No payments are made till 10 years from now, and at which time the bond you'll get your $1,000. So you're asking, what interest rate am I earning on this bond? So put the $1,000 face value. The present value, currently it's valued at $513, and the interest rate is 7%. Okay, that is what you're trying to calculate. Okay, so you're going to calculate the rate by clicking on the rate. Click on the rate function. I'll click on this cell and then go to the function wizard, click on rate and say okay. So in the net periods, you're going to add obviously the 10 years, so you're going to enter 10. So the net periods are 10. The payment is 0. What is the present value? The bond value today is, we enter as a negative and highlight that cell. Future value, we're going to get the 1,000. Type is 0. And this is what the number is. The formula is 0.68857. So this is rounding it to 7%. We can right click on that and format cells, and we can go as a number and increase the decimal to 4. Then it'll give us all the 0.666889. So that's how you would calculate the rate. Use the rate function in Excel to figure out what rate you're earning. Let's do the next problem. Travis reported that its earnings, retained earnings, they're trying to figure out what's the dividends that they paid. So the retained earnings as of year 2005 was $590,000. They earned $160,000 in 2006. So add these two to get the total retained earnings. And you don't have this information, so you know at the end of the year balance, we know we had $590,000, we made $160,000 in net income, so ending retained earnings are $750,000, out of which we are only left with $660. So obviously $750 minus the $660 equals $90,000, which we must have paid in dividends. So ending retained earnings equals beginning retained earnings plus net income minus the dividends. So 590 plus 160 minus the dividends equals which is the 750,000. So dividends equals 90,000. Okay. Next to the next problem, Rally's latest net income was 2 million, had 200,000 shares. The company wants to pay 30% of its income. So what dividend per share should the company declare? So we can calculate the earnings per share first step. 2 million divided by the 200,000 shares. That means we're earning $10 a share, out of which 30% we want to pay out, or $3 a dividend share we want to pay in dividends. Okay, so that's an easier way to calculate that out. So McCabe has 40,000 invested in a stock with a beta of 0.8 and 60,000 invested in a stock with a beta of 1.4. So you are trying to calculate the portfolio beta. So portfolio beta equals 0.8 times 40% of the investment, because 40 plus 60 is 100,000. So 40 over 100,000 is 40% of the weight. This is where you're multiplying the beta times the weight. And 1.4 times, this should be 0.6. Okay, so if this is correct, so this should be this I have to correct this. So this equals 1.4 shift over 8 times 0.6. Enter that. So that is what 1.16 is there. So this is incorrect. Let me delete that. So 0.8 times 4 is 0.32, and then this is 1.4 times 0.6, so this is 1.16. So when you add these two and click on sum, so 1.16 is the new portfolio beta. So that's how you would calculate that, 1.16. Okay. So let's do the next problem. A share of common stock paid a dividend of $3. The long run growth rate for this stock is 8%. Investors want a 12% return. What is the price of the stock? So based on our dividend growth model, we can calculate the price of the stock. We know price of the stock is the current year dividend divided by the required rate, RS minus the G, or the growth rate. So we know the dividend was $3. It's growing at 8%. So the next year's dividend is 3.24, D1. So this is 3.24 divided by the 12% return that we want minus the 8% equals 0.4. So when you do the calculation, the price of the stock would be $81. Okay, and this should be 0.12. Okay, let's do the next one. You are considering buying a $45,000 car. You have $5,000 down. You can negotiate an annual interest rate of 10% for 5 years or 60 months. So you're calculating your monthly car payments. So you know 40,000 is the loan because you paid 5,000 down, and your interest rate is 10%. 60 is the number of periods that you have, 60 months. So you click on the payment function in Excel. Okay, so click on the payment function, more functions. So you're trying to figure out the payment. So the rate is 0.1 divided by the 12, because you're finding your monthly rate here. So that's how the 10% divided by the 12. The months are 60, and the present value is you got $40,000 loan. Future value is 0, type is 0. So you need to pay $849 and 88 cents per payment to pay off that loan. So click on the payment function. Make sure you divide the interest rate by the monthly rate by 12 months. And then of course the periods are 60 months, so that is fine time, and that's how you'd calculate that. We have 2 more problems left. Beth had 75,000 in an investment account, but she wants the account to grow to 200,000 10 years from now. What rate does she need to meet the goal? So you're solving for rate. So you know 75,000 is what she has currently. She has 10 years time. She wants $200,000. So you're solving for rate. So click on the rate function here, more functions. And the rate you're going to the net period is obviously 10 years. Okay, payment is 0. Present value is the 75,000 that she has now. Enter as negative. Future value, she wants it to be 200,000. Type is 0. So she has to earn a rate of 10.3% to make that kind of money, the 75,000 to grow into 200,000. If she earns 10% return, then that money will grow to $200,000. So that's how you would calculate that type of a problem. Let's do the last one. Trust company's pension fund projects that most of its employees will take advantage of an early retirement program, and it plans to offer in 5 years. So to fund these pensions, the firm got zero coupon US Treasury maturing in 5 years. So when they were originally issued, they were 8% coupon 30-year bonds. Their strip treasuries are currently priced to yield 10%. Total maturity value is $5 million. What is the total cost to Maguire today? So let's enter the time as 5 years because these are maturing in 5 years. Rate is 8% coupon rate stated on the bonds. It yields about 10%. 5 million is its maturity value. So you're trying to figure out what is the price, or basically you're trying to figure out the present value of this. So you click on more functions, click on present value. So the rate you have is 10%. This is what you're earning, 10%, not the 8%, but 10%. Okay, let me delete that. Okay, and the net periods are 5. Okay, so see, this is your net periods. Okay, I need to delete that. Okay, because I keep highlighting those cells. Payment is 0. Future value is, maturity value is 5 million. I need to stop doing that. Okay, and type is 0. So this is the present value is 3,003,104,666. That is the present value, or the total price of the bond today. So when you click on the present value function, make sure you enter the rate as the 10% interest rate and the time left over, the 5 years left for those bonds maturing in 5 years. That's your 5 years time. And the yield to maturity is the 10%. So that's what the 10% you're going to enter. And then you're going to figure out, and the present value, you're going to figure out the future value is 5 million. That's what you get, and that's how you calculate what it is worth today. So I'm going to end this session today, and hopefully you should have a clear understanding, and you can refer to these problems and work on one by one on the rest of the problems. Okay. So, for an overview, so basically the primary goal of any company is to maximize the stock price per share in the long run, which is the stock's intrinsic value. And the lower the debt ratio, the bank would charge a lower interest, and that was your HAMDA equation that we went to. And you know that money market instruments are both long-term, short-term debt and common stocks. So so review your semi-strong efficiency, what it means, the theory of that. And then we have gone and we have gone over all the things basically. So the risk is the greater the small company stocks are riskier than large company stocks, and long-term bonds, obviously because of the interest rate risk, the long-term corporate bonds have a greater risk than government bonds and treasury bills and so on. So you know how to calculate the HAMDA equation, you know how to calculate residual dividends, you know how to calculate the price of a stock, and you know how to measure the riskiness of a project based on its weighted average cost of capital, and you know how to calculate the present value and the future value of a project, any projects, and the net present value and all of that. So the required rate of return depends on what the company, based on the financing decisions, the companies each may have a different required rate of return based on their cost of capital and everything. Okay, and the highest rating bonds, you know, they are the bonds with the shorter term maturity. The AAA is the highest rating. Okay. So basically, let me conclude this here, and hopefully if you have any questions, do send me an email.